In 2000, a young trader named Rohan, well, let's just call him that for now, put his entire savings into an internet company that had never made a single rupee of profit. The company had no real product, no customers to speak of, just a website, a big dream, and a story that everyone wanted to believe. Rohan wasn't stupid. He was smart. He had a good job. He read the news. He understood numbers. But he watched the stock double in 3 months, then double again. And he told himself the same thing millions of people were telling themselves at the time. This time, it's different. We all know how that story ends. Now, fast forward to today. Swap internet for AI. Swap that no-name company for some of the biggest names in the world. Companies spending unbelievable amounts of money building AI infrastructure, data centers, chips, and software. Their stock prices have shot up so fast that some of them are now worth more than entire countries' economies. And a question is quietly building in the back of everyone's mind, whether they're a big investor or someone with just a small SIP running every month. Is this AI boom the real deal, or is it 2000 all over again, just wearing a new outfit? Here's the thing about bubbles. Nobody ever thinks they're in one while it's happening. That's not an accident. It's psychology. Part 1. The common mistake. Believing. This time it's different. Most people assume that a stock market bubble is caused by bad math. Too high a price, not enough profit to justify it. But that's only half the story. The real fuel behind every bubble in history is a very human feeling, the fear of missing out. Think about Priya, a 26-year-old marketing professional in Pune. She sees her college friend post a screenshot of gains from an AI-related stock. Her friend didn't do any research. She just heard the word AI and jumped in, and it worked. Priya starts feeling a very specific kind of pain. Not the pain of losing money, but the pain of watching someone else make money while she does nothing. Behavioral economists have a name for this. It's called herd behavior, and it's one of the oldest tricks the human brain plays on us. Our brains are wired to think that if a lot of people are doing something, it must be safe. That instinct kept our ancestors alive when running from danger with the crowd. But in the stock market, the crowd is often running straight into the danger, not away from it. So Priya buys in, not because she understands the company's business model, not because she's checked whether its profits justify its price. She buys in because staying out feels scarier than jumping in. That single decision, repeated by millions of people across the world, is what actually inflates a bubble. It's not the AI technology that's dangerous. It's the psychology around it. Part 2. Breaking down what's actually happening. Let's simplify what a bubble even means, because the word gets thrown around a lot. Imagine you're buying a mango. If a mango usually costs 20 rupees and someone tries to sell it to you for 20,000 rupees because everyone wants mangoes right now, you'd laugh and walk away. The price has completely disconnected from what the mango is actually worth. That's exactly what happens with stocks during a bubble. The price of a company's shares moves so far ahead of its actual profits and real business performance that buying it is no longer really investing. It's closer to gambling on the hope that someone else will pay even more for it later. Right now, some AI-related companies are trading at prices that assume decades of flawless, uninterrupted growth. Investors are essentially betting that AI will transform every industry on Earth and that these specific companies will be the ones to profit from it perfectly and on schedule. That's a big bet to make on a technology that's still very new. At the same time, this isn't a simple copy-paste of the dot-com crash. Many of today's big AI companies actually do make real profits. They have real customers, real revenue, and real cash flow funding their expansion, unlike a lot of the internet-era companies that had nothing behind the hype except a good pitch. So the honest answer isn't it's definitely a bubble, or it's definitely not. It's something more layered. Certain parts of the AI market look stretched and overexcited, while the core technology and some of the companies behind it are genuinely valuable. Part 3. The deeper insight. You're not really betting on AI. You're betting on human patience. Here's the psychological insight that most people miss. When you invest in something during a hype cycle, you're not really betting on the technology. You're betting on how long other people's excitement will last before reality catches up. Every bubble in history, tulips in Holland, dot-com stocks, Crypto in 2021 has followed the same emotional pattern: excitement, greed, overconfidence, and then, eventually, fear. The technology or asset itself was almost never the real problem. The problem was that price grew faster than patience, and eventually patience ran out. This is why even smart, careful people like Rohan get caught. It's not a lack of intelligence. It's that our brains are simply not built to sit calmly while everyone around us appears to be getting rich. We feel other people's gains more intensely than we feel our own risk. Part 4. What you should actually do differently. So what does this mean for you, practically? It doesn't mean avoid AI stocks completely, and it doesn't mean assume every rising stock is a trap. It means separating the story from the numbers. Before putting money into anything riding a wave of excitement, ask yourself one simple question. If nobody was talking about this company right now, would I still think it's a good investment based on what it actually earns? If the answer is no, you're not investing. You're borrowing confidence from a crowd that could turn around and run in the other direction tomorrow. Building real wealth has never come from chasing whatever's trending. It comes from understanding what you own, staying calm when everyone else is either euphoric or panicking, and being willing to look a little boring while everyone else is chasing the next big story. Part 5. Closing thought. Bubbles don't burst because the technology inside them was fake. AI is real, and it's not going away. Bubbles burst because human patience always runs out before human excitement does. So the next time you feel that pull, that fear of missing out on the next big thing, pause for a second and ask yourself, am I making a decision, or am I just following the crowd off a cliff I can't see yet? Thanks for watching, and subscribe. Bull Economics